Good morning, everyone. I am CA Shruti Gupta, moderator for the 40th Valuation Manthan session, Merger Valuations Practical Aspects, organized by Valuation Standard Board of ICAI. We are delighted to welcome you all to an enriching journey through valuation expertise. Without any delay, I would like to welcome the speaker for the day, CA Bhakti Shah. Bhakti Shah is a partner at SSPA and Company, and she's a chartered accountant and also a registered valuer under Companies Act 2013. She has close to 23 years of professional experience in valuation and corporate restructuring advisory. She has worked on various assignments involving valuation of companies, businesses, financial instruments, and intangible assets for merger, demerger, and other transactions, financial reporting, and other regulatory requirements. She has been involved in offering valuation services to some of the large listed and reputed companies in various sectors. She has also been involved in various corporate restructuring and family settlement. She has actively participated in ICAI Valuation Standard Committee for formulation of ICAI valuation standards issued by Institute of Chartered Accountants of India, and she was also a part of Valuation Committee of Western Indian Regional Council of ICAI. She has been one of the core members of ICAI Valuation Study Group of WIRC of ICAI. She has co-authored Chamber of Tax Consultants publication, Handbook of Valuation, and has spoken at various seminars conducted by ICAI and ICSI on valuation-related topics. Thank you, ma'am, for gracing us with your presence. We are all eager to learn from you. Over to you, ma'am.
Thank you, Shruti. So today's session, what we are going to deal with was with respect to practical aspects relating to merger valuations. We are not going to discuss valuation methodologies because the valuation methodologies are generally the same which you would have done in any business valuation or any other valuation. So our focus will be what are the issues, what are the processes one needs to follow while carrying out a merger valuation. What we will do is instead of taking question and answer session entirely towards the end, we will take a break in the middle around after 45 minutes or an hour. And we will take few questions in the middle of the session and then balance questions towards the end of the session. Whenever you're posting the questions, just mention the slide number so it becomes easy as to which slide the question is pertaining to. So we'll start the session. Before I deal with what is merger valuations, I wanted to just discuss the basic concepts of merger so that as we move along this presentation, it is very clear when I'm discussing the valuation aspects. I'll just share my screen. Is the screen visible?
Yes, ma'am.
Okay. So what do you mean by merger? Basically, merger, which is also known as amalgamation, it involves combination of two or more companies into one company. If you look at the slide, we have A Limited, and there is a proposal to merge A Limited into B Limited. Here, in consideration for the merger, B Limited needs to allot shares to the shareholders of A Limited. Now, when we say merger of A Limited into B Limited, what does it mean? It means that A Limited transfers all its assets and liabilities, business, contracts, employees, intangible assets, and transfers it to B Limited. Here, A Limited will lose its existence post-merger. B Limited is allotting shares to the shareholders of A Limited. Now, how does one determine how many shares needs to be allotted by B Limited? For that, one needs to determine the share exchange ratio. And for determining the share exchange ratio, one needs to carry out the valuation of shares of A Limited as well as the valuation of shares of B Limited. Few examples in this space is of PVR Inox Leisure, merger of HDFC Bank, merger of IDFC and IDFC First Bank. Quite some cases in this space, especially in the listed category. Now, post-merger, if you see, B Limited will have two sets of shareholders, which is shareholders of A Limited and its own shareholders. So we will move to the next slide, which talks about demerger and just see how different it is from merger. The concept remains the same. However, there are certain nuances to demerger which are slightly different from a merger case. Here you will have A Limited. A Limited has two undertakings, undertaking A1 and undertaking A2. There is another company B Limited which has its own undertaking B. Here the proposal is that A Limited will hive off one of its division undertaking A2 into B Limited. Now, what do you mean by hiving off undertaking A2? It means it will transfer the entire business pertaining to undertaking A2, all its assets and liabilities pertaining to A2, contracts, employees, intangible assets, whatever pertains to A2 will be transferred to B Limited. B Limited in turn will issue shares to the shareholders of A Limited. However, unlike merger in this case, A Limited will continue to exist. In case of merger, basically A Limited was losing its existence. Here, A Limited will continue to exist with the balance business, which is undertaking A1. B Limited will now have two divisions. One is its own division and the division which it has acquired from A Limited. B Limited will have two sets of shareholders, shareholders of A and its own shareholders. Now, how does B Limited determine as to how many shares it needs to allot to the shareholders of A Limited? Here, again, one needs to determine the share entitlement ratio, which in turn would involve determining the value of shares of B Limited. And unlike in case of merger, where you did valuation of shares of A Limited, here you will do value of shares of undertaking A2, which is being transferred. Now, how does one arrive at the value of shares of undertaking A2? This will mean that you determine the value of undertaking A2 and divide it by the existing share base of A Limited, which will give the value of shares of undertaking A2. Just for the simplicity's sake, going forward, what we will do is we'll refer A Limited in most of the cases as a transferor company and B Limited as the transferee company. In case of demerger, B Limited is also known as the resulting company and A Limited is also termed as a demerged company. And the undertaking which gets transferred is known as a demerged undertaking. Few examples in this space is of demerger of lifestyle business of Raymond Limited into Raymond Consumer Care Limited, demerger of consumer business of Tata Chemicals into Tata Consumer Products Limited. Now, in case of any merger or demerger, there are certain key regulations which one needs to keep in mind. First and foremost being the Companies Act 2013. Which are the sections which are particularly dealing with mergers and demergers specifically is section 232 to 234, read along with its underlying rules. And as per these rules, one of the requirement is that a registered valuer needs to be appointed to determine the share exchange ratio and the share entitlement ratio. Now, if there is a listed company which is involved in a merger and demerger, then even the SEBI regulations get triggered, particularly the listing regulations, then the SEBI circular, which the latest circular is the SEBI Master Circular of 20th June 23, which replaced the earlier circular of SEBI of around November 21. There are other circulars issued by NSE and BSE as well. NSE circular of 30th June 23, which replaced the earlier NSE circular of November 21. And there's a BSE circular of May 17. As a valuer, one needs to keep this regulations in mind. They have some implications on the valuations, which we will deal going forward. Apart from this, in case of any merger or demerger, there is an implication of stamp duty. Stamp duty is payable depending upon the different state law. And most of the states will say that stamp duty is payable on the court order, which in turn is based on the value of shares allotted or the value of immovable property transferred. Apart from this, there are various provisions in the Income Tax Act that deals with the tax implications in the hands of the shareholders as well as the companies. Now, say if B Limited, which is the transferee company, has to issue shares to the shareholders of A Limited who are non-residents, then in that case, even the FEMA regulations gets triggered. As per the FEMA regulations, a transferee company can allot shares to non-resident shareholders of transferor company, provided the scheme has been approved by the National Company Law Tribunal, which is NCLT. And in case of listed companies, it has to be also approved by stock exchanges and SEBI. Further, while filing the form FCGPR, which is primarily for allotment of shares, the valuation report issued by the registered valuer also needs to be filed. On SEBI circulars, NSE, BSE circulars, there are a couple of points, specific points which are relevant for registered valuer. We will cover it separately in the subsequent slides. As discussed at the start of the presentation, I said that we will not discuss valuation approaches and methods. Primarily, they are the same as business valuation. So basically, you have your three basic approaches, which are your cost approach, market approach, income approach. Under income approach, primarily it will be the discounted cash flow method. Market approach, we have three methods: market price method, comparable companies multiple method, and comparable transaction multiple method. And cost approach, if it is relevant in a particular case, then it is net assets value method or the replacement value realizable value method. We are not going into the details of these methodologies because it is the same as business valuation. Now, for any merger and demerger, what is the ultimate objective? The ultimate objective is to determine the share exchange ratio or the share entitlement ratio. And in determining the share entitlement ratio or the share exchange ratio, the attempt is to arrive at the relative value. Now, what is relative value? Relative value will generally mean that a valuer should apply similar approaches, similar methodologies, and give similar weightages to both the transferor company as well as the transferee company to arrive at the share exchange ratio. However, this may not always be true. In certain cases, there are exceptions, like if you're looking at a merger of an investment holding company into operating entity. Now, for the operating entity, you may end up using DCF method under income approach. You may end up using a CCM method under the market approach. For an investment holding company, neither of these methods can be used. One will have to use a net assets value method under cost approach. And while arriving at the net assets value method, one will have to determine the underlying investments at the fair value, which involves again using DCF or a CCM method as may be applicable. The second exception will be merger of an unlisted company into listed company. For the listed company, apart from using DCF method and a CCM method, one will also use a market price method under a market approach. However, for the unlisted company, one will not have a market price, and therefore only two methods will be used. Third exception is the demerger of a division of a listed company into a listed entity. Now here for the listed company, as I said, you will have, in addition to DCF and a CCM, a market price method. However, a division, though it is of a listed company, is not separately listed on any stock exchange. So in spite of the transferor company or the demerged company being listed, the division which is getting demerged, we will not be able to take the market price. We may end up using just the DCF method or a CCM method. There are various judicial pronouncements in the past which have been very important, and they are all landmark judgments for mergers which have taken place in the past. As a valuer, one should read those case laws and at least keep them in mind. One was the decision of Supreme Court in the case of Hindustan Lever Employees Union versus HLL, where the Supreme Court laid down that it is fair to use a combination of well-known methods, which even today we are using this practice, and even the ICAI valuation standards encourage using a combination of methods. The second judgment was in the case of Mihir Mafatlal versus Mafatlal Industries and Dinesh Lakhani versus Park Davis, where the courts held that exchange ratio will not be disturbed by courts unless it is objected and found grossly unfair. These were quite a landmark judgments in the past, because in the past there were no ICAI valuation standards or there were no rules governing the valuation provisions. And that's why these decisions of the courts were taken as a guidance for any merger or demerger. Now, how does one arrive at a share exchange ratio, and how should a registered valuer put it in the report? So if you look at this example on the left side of the screen, there is a merger of company A into company B. The valuer has adopted three approaches. He has worked out the valuation under asset approach. He has worked out the valuation under income approach, and he's also worked out the valuation under market approach. Then he has applied similar weightages. for the values arrived at under each of the methods for the transferor as well as the transferee company. So he has decided that asset approach is not relevant and therefore 0% weightage has been applied. Income approach and market approach has been applied a 50-50% weightage, based on which the relative value per share has been worked out for company A and company B. After he has determined the relative value, now he needs to determine what is the share exchange ratio. So he has done what one will do is the value per share of company B is divided by the value per share of company A, which gives the exchange ratio of 2.5. Now, how does one put this in the report? So the way to put it will be that 2 equity shares of company B will be allotted for every 5 equity shares of company A. Similarly, for share entitlement ratio, in case of a demerger of an undertaking of X of a company into company B, you will work out the value per share under each of the methods, try and have similar approaches, give similar weightages, and arrive at the relative value per share of company B and the relative value per share of undertaking X of company A. Again, similarly, the value per share of company B will be divided by the value per share of undertaking X of company A to arrive at the share entitlement ratio, which is 5 in this case. And the way to put it in the report will be 1 equity share of company B will be allotted for every 5 equity shares of company A. Now, in addition to this, if the merger was or merger involved a listed and an unlisted company, the SEBI Master Circular of June 23 deals with certain additional aspects which one needs to keep in mind as a registered valuer. It says that whenever there is a merger of an unlisted company into unlisted company, or if there is a demerger of an undertaking of an unlisted company into a listed company, then for arriving at the relative value per share of listed company, in addition to arriving at the relative value of the listed company's shares, one needs to also consider the price per share of listed company as per the ICDR regulations. Now, what is the pricing formula that has been laid down in the ICDR regulations? It says the price of equity shares of a listed company shall not be lower than higher of the 90 trading days volume weighted average price preceding the relevant date or 10 trading days volume weighted average price preceding the relevant date. Now, first we'll discuss what is relevant date. As per the SEBI ICDR regulations, relevant date, whatever has been defined, is only relevant for the purpose of preferential allotment. For the purpose of merger or demerger, the SEBI circular has clarified that the relevant date for computing the price of the listed company is the date of board meeting in which the scheme has been approved, in which the scheme is approved. So, for example, if the board meeting was held on 13th of Jan 2024, which is yesterday, then the relevant date for computing the price is yesterday, and your 90 trading days will end on a Friday, which is 12th Jan. Similarly, 10 trading days. Now, what happens? Why they have asked to compute this price? What is the relevance of it? So, for example, I'll go to the previous slide. Say in this case, company B was a listed company. Now, you have arrived at a relative value per share of 295. Say if the ICDR pricing comes to 250, whether will it have an impact on the share exchange ratio? No, it does not have an impact on the share exchange ratio because the relative value per share is higher than the ICDR price and it is beneficial to the minority shareholders of company B. Let's look at a reverse case. If you look at the screen, in this case, my value per share of company B as per ICDR regulations is 330, which is higher than the relative value per share of 295. In this case, the SEBI circular, as per the SEBI circular, you cannot issue shares at 295 rupees and therefore the share exchange ratio will be based on the ICDR price of company B, which is 330, and the relative value per share of company A, which is 118, and the ratio works out to 2.8, which means 5 equity shares of company B will be allotted for every 14 shares of company A. This needs to be kept in mind by a valuer whenever there is a merger of an unlisted company into listed company or a demerger of an undertaking of an unlisted company with a listed entity. Now, once the valuer has done the valuation, he has concluded on the ratio. The next step is to prepare a report. Now, the report contents of the report has been laid down in the ICAI valuation standards as well as the registered valuer rules. The content of the report, they have given the various clauses which the report should cover. However, as a matter of practice, over a number of years, if you look at any of the reports which deals with merger or demerger, you will not see any valuation workings which are forming part of the report. Having said so, the summarized workings needs to be provided separately by the valuer to the companies for submission to the stock exchanges, SEBI, and the regional director. In fact, prior to 2017, if you look at any merger reports or any reports on demerger, there is nothing mentioned except for the share exchange ratio. In 2017, there was a NSE BSE circular which said that the report should also include the value per share arrived at under each of the methods and what is the relative value per share which has been worked out by the valuer. If you see the third bullet where the table has been put, this is what was inserted by the NSE and the BSE circular saying that this is required to be displayed in the report. Now, based on this, they need to disclose what is the asset value per share which has been arrived under the methods using the asset approach or an income approach and market approach. And then the circulars in fact said that if a particular method or approach is not used, the valuer should give a rationale why a particular approach has not been used. This now has been incorporated into the SEBI Master Circular as well, and even it is part of the NSE Master Circular of June 23. In few cases in the recent past, even though summarized workings have been submitted to the stock exchange and SEBI, in certain cases, SEBI and stock exchanges have still asked for detailed workings, and a registered valuer may have to provide those workings to the companies to enable them to submit it to the stock exchanges and obtain their approval. Now, in terms of report, there is a practice wherever there are listed companies, generally there is a practice of appointing two valuers. Further, there is a practice that either both the companies will appoint the valuers jointly. So if there is a single valuer, maybe both the companies, the transferor and the transferee company will appoint a single valuer jointly. Or there are cases where there are two valuers appointed, where company A will appoint Mr. X, company B will appoint Mr. Y. Now, after this, the companies may insist that we want a joint report, or they may be okay with a separate report. What do you mean by a separate report? Mr. X will issue his own report separately. Mr. Y will issue his own report separately. And what do you mean by joint report? Joint report is where Mr. X and Mr. Y will sign the document or the report jointly. Now, one thing needs to be kept in mind whenever there are two valuers appointed, both the companies, the transferor and the transferee company, needs to give same set of information to both the valuers so that whenever they are doing their workings, there is no discrepancy in terms of the information that has been provided. And while the joint report or a separate report, irrespective of whether it's a separate or a joint report, it will be preferable that both the valuers have a consensus on the share exchange ratio that they are recommending. What do you mean by consensus? Basically, it does not mean that the methodologies have to be same. The value per share needs to be same. They can be different. Mr. X may appoint different methodologies and have a different value per share under each methodology and may arrive at a different relative value per share also. Mr. Y may work his own, select his own methodology. He may have his own value per share and may arrive at a relative value per share, which is slightly different from Mr. X. However, the ratio needs to have a consensus is something which is recommended. There was a case of Hindustan Siba GG and Sendos India somewhere in the year of 1997. Here the companies appointed three valuers. All three valuers gave different ratios. So the board of directors did an average of ratio and they recommended a fourth ratio for the purpose of merger. This was objected by the minority shareholders and then the courts appointed a fourth valuer to carry out a valuation and recommend a ratio. From that time onwards, it has become a sort of a practice that it is more advisable to have a consensus, because if there is no consensus between the two valuers and if the board recommends some other ratio, it is definitely going to be challenged by the public shareholders, thinking that it is a ratio which is biased towards a particular company. Apart from this, in case of listed companies, there is a fairness opinion which is required from a SEBI registered merchant banker. What is this fairness opinion? Basically, the registered merchant banker needs to opine on the fairness of the ratio which is recommended by the registered valuer. Now, in case of any merger demerger which involves listed company, ideally the registered valuer cannot disclose the ratio or share the report with anyone other than the audit committee of the company. So, how will the registered merchant banker give his opinion on the fairness of the ratio if he does not have an access to the registered valuer's report? Here, there are no guidelines, or there is no, basically anything written in the law or in the provisions as to how this can be achieved. So, as a matter of practice over a number of years, the way the process is being followed is the companies will request the registered valuer to share their workings, draft workings with the merchant banker, hold discussions with the merchant banker, also share the final recommendation with the merchant banker and the draft report with the merchant banker, which the merchant banker in turn will review the workings which are shared by the registered valuer. He will also carry out his own analysis before opining on the fairness of the ratio recommended by the registered valuer. One needs to keep in mind that the merchant banker and the registered valuer have to be independent of each other. There cannot be any conflict of interest, no common directorship, no common partnership. Now, this is a process which is followed practically, though there has been nothing laid down anywhere in the Companies Act or in the SEBI regulations. Next step is the report is ready. Now the time has come for the board meeting. And how does one share the report with a list, especially in case of a listed entity? So here, the registered valuer is required to make a presentation to the audit committee of the listed company, wherein he will explain what is the process that he has followed while carrying out the valuation, what is the information that he has relied upon, what are the different methodologies and approaches he has used for arriving at the value per share. Now, if he has used a DCF method, he will also have to explain what were the components of the discount factor that he has considered. If he is using a comparable companies multiple method, he will have to explain as to what was the multiple used, which are the comparable companies that he has considered. If there are any significant adjustments that have been made to the valuation, he will have to explain those also. And finally, he will submit his report on recommendation of the exchange ratio to the audit committee. After this, the second process will be to make a similar presentation to the board of independent directors, committee of independent directors, again explaining the same thing what the registered valuer explained to the audit committee. The audit committee and the committee of independent directors will in turn submit their recommendation to the board of directors of the company. Further, as I said, even the fairness opinion of a SEBI registered merchant banker needs to be provided to the board of the listed entity. The board of directors of the listed company will take into consideration the report which is submitted by the audit committee, the committee of independent directors, the fairness opinion of the merchant banker before giving their final approval to the scheme and the share exchange ratio. Now we will cover certain aspects of the SEBI Master Circular. The SEBI Master Circular uh, and the NSE Master Circular of June 23, they deal with aspects pertaining to merger. So apart from there are many aspects which are covered, we are going to deal with certain aspects which have some implications on the valuation. As per the NSE Master Circular, they have said that the board of directors of the company needs to consider the scheme of amalgamation within 7 days of the issuance of valuation report, which will indirectly mean that if I have issued a report on Monday, which is on 15th of Jan 2024, if the board meeting is not held by the end of the week, then the report which has been issued will have no relevance and the company may have to obtain a fresh valuation report. Apart from this, they have laid down that within 15 days of the approval of the scheme by the board of directors, The documents along with all valuation report needs to be submitted to the stock exchanges. And here they have gone to the extent of clarifying that if this timeline is not met, then the board of directors will have to again have, there has to be another board meeting to take a fresh approval of the board of directors after obtaining fresh valuation report. So first is your valuation report will also become invalid, and one will have to do a new valuation report, and also a fresh approval from the board will have to be required. Basically, the intention here is that once the scheme has been approved by the board of directors, the company should not delay the process of obtaining approval from the stock exchanges, because they feel that if they come after 2 months, 3 months, 4 months, maybe the report which has been worked out will not be valid after 2 3 months. There may be changes in the companies, and which may not be ideal for the minority shareholders. Apart from this, they have said that audited financial, if there's a merger or a demerger of an unlisted company into a listed company, they have said that the audited financials of the unlisted company should not be older than 6 months at the time of submission of the scheme. And the same should have been used for valuation under income approach, which means same should have been used for valuation under DCF method is primarily what they are saying. In addition to this, there is one more clause which they have inserted, that for any other than income approach, which they are really, talking about cost approach and the market approach, the audited financial should not be older than 3 months. So basically, for all practical purpose, the audited financials of the unlisted entity, whether you use a DCF method or whether if you're using a CCM method as well as a DCF method, the audited financial should not be older than 3 months. Now, this has been brought in the NSE Master Circular June. In the previous circular, the audited word was not there. They talked only about financials. However, they have brought in audited financials, and a conservative view which has been taken that this audited financials requirement is applicable to both listed companies as well as unlisted entities. Even today, if there is a merger of two listed entities, or if there is a merger of unlisted entity to listed entity, they are requiring audited financials of both the companies, the listed as well as unlisted company, that they should not be older than 3 months. Now, this is posing practical challenges sometimes. However, the companies need to manage this, and the registered valuer needs to keep in mind, because if he does a valuation which is not based on audited financials, or if he does the valuations on audited financials which are older, more than older, 3 months, SEBI is or stock exchanges are not likely to approve the report or accept the report, and it will be rejected. So one needs to keep this in mind. Generally nowadays, how the companies are managing this is, if your last financial ending is 31st December, the companies try to hold the board meeting before 31st of March, so that there is no issue when it comes to this requisition. Secondly, in terms of audited financials, for the unlisted company, there is no choice but to adopt the unaudited, but to get the financials audited. In case of listed entity, still the limited reviewed financials are acceptable. Now, dealing with the SEBI Master Circular. SEBI Master Circular has laid down certain instances, where one of the instances that there is no report required in case of a merger of a wholly owned subsidiary into its listed parent company, or demerger of an undertaking of a wholly owned subsidiary into its listed parent company. The reason being that whenever there is a merger of a wholly owned subsidiary with its listed parent company, or a demerger of an undertaking of a wholly owned subsidiary into listed parent company, the listed parent company's shareholding does not change. The capital structure of the listed parent company does not change, because they are not allotting any shares, and therefore there is no valuation required. However, I have seen that some instances, some of the companies have still obtained a report from a registered valuer, in which the registered valuer just mentions, because there is a merger of a wholly owned subsidiary with the listed parent company, there are no shares required to be allotted, and therefore no valuation is required. In my view, that is not still required, because the SEBI Master Circular is quite clear in this. Now, let's look at the next instance which has been covered in the SEBI circular. This says that a registered valuer can recommend a share exchange ratio or share entitlement ratio, without carrying out any underlying valuation. So the registered valuer will recommend a share entitlement ratio, but the share entitlement ratio is not based on any valuation. Let's look at this example. Here we have A Limited. A Limited has two divisions, Division X and Division Y. There is a proposal that A Limited will demerge Division Y into a new company which does not have any business. It will be existing company, but the requirement is that there should not be any business. Second is that the new company's existing share capital will be cancelled pursuant to demerger, and the new company will allot shares to the shareholders of A Limited. What are the requirements that one needs to consider before coming to a conclusion that a ratio can be recommended without carrying out a valuation? First one being that the company, the transferee company or the resulting company should not have any business. Secondly, the existing share capital of the transferee company is to be cancelled on demerger. Whoever are the shareholders of A Limited, all the shareholders of A Limited have to become the shareholders of B Limited. The shareholding pattern of A Limited and B and the new co has to be exactly the same. Basically, what we call as a mirror image shareholding. In such cases, the registered valuer can recommend a share entitlement ratio without carrying out the valuation of the resulting company and without carrying out the valuation of division by. This is also known as plain vanilla demerger. The classic case of this being recent one is the demerger of financial service business of Reliance Industries into Geo Financial Services Limited. There was demerger of pharma business of Aarti Industries into Aarti Pharma Labs. There was demerger of spinning division of GHCL into GHCL Textiles. There are a couple of examples in the listed space for such type of merger. So the logic here was simple, that because the beneficial ownership of the resulting company or the division Y is not changing. If you see here, what we said is there is a mirror image shareholding. So if A had 5 shareholders, each holding 20%, they will hold in the new company also 20% stake each. And since there is no change in the beneficial ownership, there is no valuation required. So the valuer has to mention this rationale in the report, why the valuation is not carried out, because all the shareholders of A Limited are holding shares in the resulting company in the same ratio as they were holding earlier, and the beneficial ownership of the entity does not change. Now let's look at a slightly different case. Here there is A Limited. It has two divisions, X and Y. B Limited has another division, which is division Z. There is a proposal that A Limited will demerge division Y to B Limited. And in turn, B Limited will allot shares to the shareholders of A Limited. Now here, B Limited has its own business. Secondly, B Limited's existing share capital is not getting cancelled pursuant to demerger. And therefore, the shareholding pattern of B Limited is not the same as A Limited in this case. In this case, this evaluation is required because all the points which we discussed earlier required for a plain vanilla demerger is not fulfilled here. And this is also known as a non-vanilla demerger. Again, lot of instances in this space. Demerger of consumer products of Tata Chemicals into Tata Global Beverages. There are many such cases for this. Now let's look at a slightly different case which we discussed from the earlier two. Here there is A Limited. A Limited has two divisions, X and Y. A Limited has a wholly owned subsidiary, C Limited. A Limited proposes to demerge division Y into C Limited, and C Limited in turn will issue shares to the shareholders of A Limited. Here there is a slight distinction. The existing share capital of C Limited is not proposed to be cancelled. C Limited does not have any business. Okay, that is similar to our first case, but here the existing share capital of C Limited is not proposed to be cancelled. C Limited is proposing to allot shares to the shareholders of A Limited in such a way that A Limited will hold 40% and the shareholders of A Limited will hold 60%. Now, in this case, also the registered valuer has given a ratio without carrying out a valuation, stating that the ultimate beneficial ownership of C Limited is directly and indirectly held by the shareholders of A Limited in the same proportion as they were holding earlier. So basically, shareholders of A Limited is holding 60% directly, and balance 40% they are holding it through A Limited, and therefore there is no valuation required. This is done in the case of demerger of hotel business of ITC Limited into ITC Hotels. The scheme is yet to be approved by the stock exchanges. So we will have to wait and watch as to how SEBI looks at this valuation report and whether they will approve the scheme. There is one more peculiar case which we deal with, uh, which where a report again will there is a report which can recommend a ratio without carrying out a valuation. So let's look at this instance. There is an operating company which is held by two sets of shareholders. One is the promoter company holding 20,000 shares with 20% stake, and there are other shareholders holding 80% stake and 80,000 shares. There is a proposal to merge the promoter company into the operating entity, whereby the share capital held by the promoter company in operating company, which is that 20,000 shares, will be cancelled, and the operating company will allot same number of shares to the shareholders of the promoter company, which are the promoters. So they will allot 20,000 shares to the promoters of the promoter company. So if you look at the post-merger structure of the operating company will have again 80,000 shares, 80% stake held by other shareholders, and 20,000 shares, which is 20% stake, instead of promoter company holding it, is now being held by the promoters. Now, in this case as well, a registered valuer can issue a share exchange ratio, can determine a share exchange ratio without carrying out the valuation. Now, what are the points which one needs to keep in mind before coming to that conclusion? So first of all, one should this points will be very important, without which one cannot recommend a ratio without a valuation. So first of all, the promoter company cannot have a negative net worth. Secondly, the shareholding pattern or the capital structure of the operating company does not change. So if you say prior to merger also it was having 1 lakh shares, post merger also it was having 1 lakh shares. Secondly, the beneficial interest of the other shareholders should not get impacted. So if you look here, the other shareholders continue to hold 80,000 shares with 80% stake. Their beneficial interest is not changing because of this merger. Other 2 points which are important are any expenses pertaining to this scheme has to be borne by the promoter company or the promoters, and any liability that may arise pertaining to the if there's any litigation pertaining to the scheme will have to be borne by the promoters. Now, the last 2 points have to be covered in the scheme, and also the registered valuer should obtain a management representation letter in this regard. Couple of practical cases in this also we have seen is in case of Rossell India, Hero MotoCorp, Welspun Corp. I've just missed one particular point in the previous slide of plain vanilla demerger, so I'll take you back over there. Sorry. Here, for determining the share exchange ratio, as I said, there is no valuation to be done. How does one determine what is the share exchange ratio? So here, what generally happens practically is the management decides what is the target capital structure of the resulting company that they are looking at, which in turn will be determined based on the profitability of the division which is getting demerged. What is the serviceability of the capital based on this profitability that the company can give. Third is that they will try to avoid any fractional entitlements. So basically, they will say that they should not give a ratio which will result in fractional entitlements, based on which the management will decide the target capital structure, and post that the valuer will be able to recommend the share exchange ratio, share entitlement ratio. I'll pause here, and we can take up questions up till this slide which we have covered.
So sure, ma'am, there are a couple of questions.
Yeah.
The first one is from slide 5. What about
Okay.
applicability of GST?
For mergers and demergers?
Ma'am, particularly, yes. I am not sure what was in slide 5.
Yeah. Okay. So GST, I'm not very sure on mergers and demergers. What is the applicability? We may have to check because that's not pertaining to valuation, and I have not dealt with GST separately.
Ma'am, the next question is net asset value method acceptable as per valuation standards?
So net assets value method is acceptable in certain cases. So basically, when we are dealing with a valuation of an investment holding company, you will value the all the assets and liabilities because you cannot apply a CCM or a DCF method. What one will do is they will take all the assets and liabilities at book value, except where the investments are in various companies. One will have to do a proper fair valuation of those entities and capture in the net assets value method. So it does net assets value method does not mean just purely taking the book value of assets and liabilities. Or for a company, say for example, a company has been just recently incorporated, it does not have any business plans. What do you do? And it neither has made any acquisition, it does not have any business plan, it has just been incorporated. One will have to use the net assets value method. You don't have a choice.
Thank you so much, ma'am. Ma'am, the next question is, what is the impact of merger valuation in income tax?
So in income tax, the provisions which are dealing with income tax, there is section 21B, which deals with the definition of amalgamation. There is section 2119AA, which deals with the definition of demerger. Now, if the merger and demerger, which is being taken by the companies, if they fulfill the conditions or the criteria which is mentioned in those provisions, then they are all tax neutral. Basically, there are no tax implications which arise as on account of a merger and demerger. However, if it is a non-tax compliant merger and demerger, which will be rarely a case which one can see, generally people will try to have the mergers or demergers complying with the tax provisions so that they are tax neutral.
Thank you, ma'am. The next question is with respect to slide 10, where weighted average was shown.
Weighted average. Okay. Sorry, come back again. Can you repeat that question?
The question is only where weighted average was shown. It's with respect to slide 10.
Okay, I'll just share the screen again. The weightages are shown in this, if you can see the weights which have been written 0%, 50%, 50%, these are the weightages. And the average value per share, if you see for company A is 118, which is the weighted average value per share. And similarly for company B, 295 is the weighted average value per share. I hope that was the question. And
Yes, ma'am. This is the only question, so
yeah.
maybe. Moving forward, which is the best method for valuation for merger of unlisted companies?
So for a merger of unlisted companies, as I said, see if you would have to do any valuation of any unlisted entity, what are the methodologies which you would have used? Depending on the business of the company and the nature of business, one will have to choose a method which is appropriate. So generally, one would have used DCF method under income approach and a CCM method, comparable companies multiple method under market approach. So both the methods would have been applicable and would have been used. Similarly, for this also for a merger valuation, it does not change. It will remain the same.
Thank you so much, ma'am. Moving forward, the next question is with respect to slide 15.
Yeah.
Whether consensus is required to arrive before issuing a separate report or required consensus after issuing a separate report. This matter is not clear in my understanding. Can you please help me in understanding this point?
So even where there is a separate report, ideally the consensus has to be there prior to issuing a separate report. So the way the valuers, when there are two valuers appointed, generally even both the valuers, they have to be in sync in terms of whatever is the information which has been shared, and they cannot be having two. So for example, say if the projections have been provided by the company, they cannot say that I have used a separate set of projections, one valuer, and the other valuer said I have used a separate set of projections. As I said, the information has to be same. Now, before coming to a final conclusion, it is more advisable that both of them come to a similar ratio. Now, practically, lately, I have not seen cases in last so many years where two valuers will give two different ratios, because it will not help the companies and it will not help the minority shareholders. Because how will one conclude which is the ratio which is fair? So one will have to will have to arrive at a consensus on the ratio.
Thank you so much, ma'am. Moving forward, next question is with respect to slide 20.
Yeah.
Heading says no valuation required, whereas we discussed valuation is required. Just to clarify, have I understood correctly?
Yeah. So basically, we were dealing with certain points or cases where a valuation is not required for recommending a ratio. And I had brought out a difference, then a case study which said that in this sort of a case, a valuation is required. So we were just trying to explain various case studies. So I this slide which is there, it's basically a case where you require a valuation. It's just giving you a distinction between the earlier case study and this case study.
So next question is with respect to plain vanilla. Do you mean to say that the shares will be issued based on book value if valuation is not required?
So shares are not issued based on book value. Basically, here there is no relevance of what is the book value of assets also getting transferred. What is relevant is what is the target capital structure of the new company. Say if the new company has to be listed, then they will have a minimum capital requirement, which will be 5 crores or 10 crores, depending upon the requirement. And the face value of the shares will be decided. Now, one needs to say that whether I can give a ratio which is 1:1, I can give a ratio to say that, okay, two equity shares of the resulting company can be allotted for every one equity share of company A. So the ratio is not dependent on the assets value of the undertaking which is getting demerged or the asset value of the resulting entity. One can refer to this demerger of financial services business of Reliance Industries into Geo Financials. There are a lot of demergers, means one can refer to the schemes and the reports which have been issued by the valuers. It will give more clarity as to how one determines. In fact, in case of Reliance Industries, there is a letter which Reliance Industries has submitted to the stock exchanges explaining as to why they have given a 1:1 ratio. What was the rationale for giving that ratio?
Ma'am, next question is with respect to slide 10. How does one decide the weightage to be given?
So weightage, again, say if you were doing a normal business valuation, how would you have decided the weightages? It's the same concept. So there is nothing different when it comes to merger valuation.
Thank you. Moving forward, there's one question with respect to slide 21. Since there is no extinguishment of existing shareholding, will it still qualify for no valuation report for recommendation of exchange ratio?
Can you repeat the question again?
Since there is no extinguishment of existing shareholding, will it still qualify for no valuation for recommendation of exchange ratio?
So here, if you look at it, what was the rationale for giving a ratio without doing the valuation was that the ultimate beneficial ownership of C Limited, which is the resulting company, is directly or indirectly the same, right? The shareholders of A Limited will hold 60% stake in C Limited in their own individual capacity, and then they're holding 40% through A Limited. So their shareholding directly or indirectly is remaining the same. Now, as I said, the scheme is yet to be approved by stock exchanges and SEBI. Not sure whether SEBI will approve the scheme and the way the ratio has been worked out. So we'll have to wait and watch. So there's nothing wrong which the valuer is saying, because he's saying that the ultimate beneficial ownership remains the same, whether I'm holding directly or indirectly. We will have to wait and watch, because if I remember in the past, uh, maybe 10 years back or something, such schemes were not being approved by SEBI and stock exchanges. So we'll have to wait and watch. In the
Thank you.
unlisted space, definitely you will be having such cases. In the listed space, this is the first time this has come, and we'll have to see how SEBI and stock exchanges are dealing with this. But in the unlisted space, definitely there are reports which are, recommending ratio without carrying out a valuation where such structure is adopted.
Thank you, ma'am. There's one question with respect to slide 22. Can you please repeat the conditions for slide 22?
Yeah. So here, basically, whenever there is a merger of a promoter company into an operating entity, a valuer can recommend a ratio without carrying out a valuation. First condition is that the share capital of the operating company should not undergo a change. So if you look at here in the example, 1 lakh shares remain 1 lakh shares post merger as well. Secondly, the beneficial interest of the other shareholders continue to remain the same. Their shareholding is not impacted. So basically, they held 80,000 shares, 80% stake pre merger. Post merger, also, they continue to hold the same stake. Third is whatever expenses are there of the merger scheme needs to be borne by the promoter or the promoter entity. Any liability that may arise on account of litigation pertaining to the scheme needs to be borne by the promoters. So these are few of the conditions which are very critical, and the promoter entity, which is getting merged into the operating company, cannot have a negative net worth. So I think so. These are 4-5 points which are very critical. Again, one can look at these reports of Hero Motocorp, Welspun Corp, Rossell India. When you look at the registered value report and the scheme which talks about the merger, will have all these conditions which are mentioned, or they may explain as to why the valuation has not been carried out.
There's another question. Is a valuation report required for acquisition of 100% shareholding of an unlisted company by another unlisted company?
Come back again. Is a valuation report required?
Is a valuation report required for acquisition of 100% shareholding of an unlisted company by another unlisted company?
So, as a good corporate governance, yes, it is required because it depends upon the companies, right? For an unlisted company, there are no rules or something which says that definitely you need to obtain. But I think so, as a good corporate governance, it is definitely recommended that one should take a report. Also, it becomes relevant because you may want to show it that this has been done at arm's length pricing, so there are no issues in income tax as well. So it's better to take a valuation report.
There's one last question, and then we can move ahead with
Yeah,
the session.
sure.
Is there any additional provision under FEMA for valuation norms where non-resident shareholders are required?
No, can you repeat that question?
Is there any additional provision under FEMA for valuation norms when non-resident shareholders are required?
So I'm not understood because as far as merger, the provision I have explained that they just need that the scheme has been approved by the NCLT and the SEBI in case of listed companies, and the form FCGPR which is being filed is also accompanied by a report of the registered valuer. Apart from that, if you're talking about issue of shares which are happening to non-resident shareholders or transfer of shares from a non-resident shareholder to a resident shareholder, vice versa, obviously there are separate provisions on valuations which are required to be complied with. What I have covered here is only pertaining to dealing with merger and demergers.
Thank you so much, ma'am. We can move ahead with the session.
Yeah, sure. So now what are we going to deal with in the subsequent slides is the practical issues or challenges one faces while dealing with merger and demerger valuations. Up till now, what we covered is what was covered in the SEBI Master Circular, NSE Master Circular, Companies Act process and all those things. So let's move ahead with the practical issues. Now say I am doing a valuation for two mergers today. Merger of A Limited into B Limited and merger of X Limited into Y Limited. For merger of A Limited into B Limited, the appointed date of merger is say 1st Jan 2024, and merger of X into Y Limited, the appointed date is 1st April 2024. The board meetings for both these mergers are to be held on 15 Jan 2024. Now, while I have to derive the ratio, obviously I need to carry out the valuation. So what is the valuation date for both this merger? Whether the valuation date has to be the same as the appointed date, which means in case of merger of A Limited into B Limited, my valuation date will be 1st Jan 2024. And in case of merger of X into Y, whether the valuation date will be 1st April 24. Now, before answering that question, let's understand what is an appointed date. Appointed date, what does it signify? It means that on this date, on and from this date, all the assets and liabilities of the transferor company or the demerged undertaking will be transferred to the transferee company. The valuation date will be as of the current date. So if my board meeting is tomorrow, my valuation date will be either as of today or as of tomorrow, depending upon what are the facts of the case. The appointed date has no relevance when it comes to the valuation date. So even though the appointed date may 1st April or it could be 1st Jan 2024, for me, my valuation date will be 14 Jan 2024. Coming to the next question, in case of any merger and demerger, various synergies arise either on account of operational efficiencies or it could be because of the cost reduction, administrative cost reduction. Now, whether one should consider such synergy benefits into the valuation while arriving at the relative value of shares of the transferor and the transferee company. It should not be considered. Both valuation of the transferor and transferee company needs to be done on a standalone basis without considering these synergies. Now, say company A is merging into company B Limited. Company A holds certain investments in company B. Basically, there is intercompany holding. Now, how does one capture the value of investments in company B held by company A while carrying out the valuation of company A? So, say if you're using just a single method in both the cases, say you are just using CCM method for valuing the shares of company B for arriving at the relative value, and for even the relative value of company A, I'm using CCM method. There is no confusion. But say if I'm using two methods, I'm using DCF method and CCM method for both companies for arriving at the relative value, then how do I capture it? So in such cases, while arriving at the relative value per share of company A, specifically while arriving at the DCF value of shares of company A, I'll capture the value of investments in company B at the DCF value of company B. Similarly, while arriving at the value per share of company A under CCM method, CCM method, I'll capture the value of investments in company B at the CCM value of company B. Now, say if company A and company B belong to the same family group, they are private limited companies and they belong to the same family group, can I recommend a share exchange ratio for based on just the NAV value per share of both these entities? So what I'm trying to say here is that I'll work out the relative value per share of company A and company B just by using a net assets value method and a cost approach method. I will not use DCF method. I will not use a CCM method. I am assuming here that both company A and company B are operating entities and they are not investment holding entities. In my view, it is not advisable or recommended to just do a ratio recommendation based on NAV method. If you look at the ICI valuation standards as well, they talk about one, the valuer needs to evaluate which methods are appropriate. They need to then select which methods are not applicable. So if I'm using NAV method and not using CCM and DCF method, as a valuer, I need to have a rationale as to why these methods cannot be used. And if there is no reason for not using a particular method, it may be incorrect not to do the valuation as per this method, as per the other methods and recommend a ratio. Now, say in case of company A and company B merger, they are listed companies. So how does one derive the market price under market price method? There are a couple of aspects which one needs to look at. First one, what is the duration and the period for which the market price needs to be considered? What is the manner of computing the market price? And third, the date up to which the market price needs to be considered. So let's look one by one. First comes the duration or the period for which the market price needs to be considered. Various valuers have different practices. There is nothing right or wrong because there is nothing given anywhere, either in the IC evaluation standards or in any SEBI regulations as to this is the period for which the market price needs to be considered for merger. They have just broadly said that it should be for a reasonable duration, which will mean that one should not consider it for just one day or 1 week and say this is the market price. They have said that that has to be for a reasonable duration. Now, some valuers use 6 months period, some valuers use 3 months period, some even use the ICDR pricing formula, which is 90 trading days volume weighted price or 10 trading days volume weighted average price, whichever is higher. There's nothing right and wrong. One can adopt a particular approach period and use it consistently for all the evaluation exercises. The second comes, how does one compute the market price? So now you know that, okay, I have to compute it for a 3-month period. You decide that I will compute for a 3-month period. How do I compute this market price? Again, there are two practices being followed. One is the volume weighted average price for the 3 month period. The second one is to say that I'll take a average of daily volume weighted average price. So I'll explain you by way of an example here. If you look at the left side, which I said is the volume weighted average price. So what happens here? I have given an example of 10 trading days. For the 10 trading days, I will plot what is the volume of shares which have been traded and what is the turnover which has got traded in those on those days. The total turnover for this 10 days will be divided by the total volume of shares traded for this 10 days to arrive at the volume weighted average price, which is 2623.95 in our example. If you look at the right side, here, how does one compute it? Here, on a daily basis, I'll work out what is the volume weighted average price. So if you look at the third column, it is the turnover of that single day divided by the volume of that single day, based on which the daily volume weighted average price is considered. And then finally, you are averaging the daily volume weighted average price for this 10 days to arrive at the market price. Again, there is nothing right and wrong. But one can refer this that in case of takeover regulations and the ICDR regulations of SEBI, they have recommended a volume weighted average price. But it is a firm stand which one takes. And generally, once you have taken a stand, you will follow that stand for all your valuations of a listed company. Third comes the date up to which the market price needs to be considered. Now, here, different companies follow different practices. There are certain companies which make a two-stage announcement. There are certain companies which just have a one announcement. Now, say if there's only one announcement, which means that the company will announce that the board meeting will be held on so and so date to consider the merger of A Limited into B Limited. In such case, it is very clear that the market price needs to be considered up to the date of this announcement. Now let's look at a case where there's a two-stage announcement. What do you mean by two-stage announcement? So in the first announcement, the company will say that, okay, the board has given an in-principle approval for merger of A Limited into B Limited, and committees have been formed to appoint various agencies like the registered valuer, lawyers to draft the scheme and to recommend the share exchange ratio. Then after a few days or a week, they make a second announcement that the board meeting will be held on so and so date to give the final approval to the scheme and approve the share exchange ratio. In such cases, ideally, the market price has to be considered up to the date of first announcement only. It should not be stretched to the date of the second announcement, because more likely or not, once the first announcement has come, the market price will react to this news. However, it's a valued judgment as to what he feels is appropriate. In case of two-stage announcement, sometimes companies do not disclose as to what they are planning to do. So, for example, they may just say in the first announcement that the board is considering various restructuring proposals and committees have been formed to evaluate various merger proposals, appoint agencies to work out the details. And then there is a second announcement whereby they will say the board meeting will be held on so and so date to approve the scheme of merger of A Limited into B Limited. Now, if you look at this instance, in the first announcement, they have been quite vague in disclosing as to what they plan to do. In this case, again, the valuer needs to evaluate the announcement properly, see whether the market prices have really reacted to such news or not, and accordingly take a call as to up to which date the market price needs to be considered. Now, here just one thing needs to be kept in mind. Say if the announcement comes post market hours, so say tomorrow, the board of directors of, say the management of A and B Limited, they make an announcement to merge post the market hours, then the market price needs to be considered up till tomorrow. However, if the announcement is made during market hours, then it will be advisable for the valuer to take the market prices one day prior to the date of announcement. Say now A and B Limited have different face value of shares. So A Limited, the face value of shares is 10 rupees, and B Limited, the face value of shares is 100 rupees. whether it will have an impact on the share exchange ratio. So we'll go back to our old example, which we had covered. If you look at the left side, company A's face value is 10 rupees, company B's face value is 100 rupees. Now, as I said, that the share exchange ratio has to be determined based on the relative value per share, and therefore the face value of shares has no relevance. So if you look at the share exchange ratio, which has been written below the table, it says that two equity shares of company B of face value of INR 10 each will be allotted for every 5 equity shares of company A of face value of 100 each. So as I said, the ratio is not dependent on the face value, it is dependent on the relative value per share. If you are appointed as a registered valuer, whether there is a single registered valuer, whether it is okay to give a single ratio or a range of ratios. We have slightly discussed that in terms of two valuers, but say as a single valuer, will it be okay to give a range of ratios? There is no law which prohibits you from giving a range of ratios. However, it can create issues for the management of the companies, because then as a valuer, you are not giving one single ratio. That means the board has to select which ratio to adopt. And if the board is selecting a ratio, the shareholders, minority shareholders, especially in case of listed companies, will feel that the management is biased toward a particular company. And therefore, it will always be recommended that as a valuer, it's better to give a single ratio. Now, say A Limited and B Limited, when they are proposing to merge, B Limited declares a bonus. The board of directors, they approve a bonus prior to the board meeting approving the scheme. Now, in this case, since the bonus is yet to be approved by the shareholders and the record date has yet not passed prior to the board meeting approving the scheme, the valuer has to give a ratio in his report, pre-bonus as well as post-bonus. So he'll have to give two ratios. Let's look at another instance where B Limited does not declare the bonus prior to the date of the board meeting approving the scheme, but they declare the bonus post the approval of the scheme of merger on the same day. In such cases, generally in case of listed companies, the registered valuer may not be made aware of this information because it's a price sensitive information and he may not be aware of it. In this case, post the board meeting approving the scheme, the management of the companies will approach the registered valuer and request them to issue an addendum to their report to give a ratio even post bonus. And it is very critical that this is obtained from the registered valuer, because both ratios need to be mentioned, and otherwise the report will not be accepted by the SEBI or the stock exchanges. Let's look at an instance where A Limited proposes to demerge its undertaking into a new company, where new company is not yet incorporated. Whether as a valuer can one recommend a share entitlement ratio in such cases? Now, there have been instances where the share entitlement ratio has been recommended by the registered valuer. In those instances, one needs to keep in mind that the new company's details in terms of what is the proposed authorized share capital of the new company, in terms of the number of shares and the face value, needs to be mentioned in the scheme, and the registered valuer needs to also obtain an MR with this regard. And second, generally in all these cases, wherever the ratio was recommended, the new company, though was not incorporated on the date of issue of the report, the new company was eventually incorporated before the scheme got approved by the courts. So it is possible there was this scheme of couple of schemes. One of them was of, I'll just tell you the name of the scheme where this was done. So it was demerger of wire harness business of Motherson Sumi Systems. So one can definitely give a ratio, even though the company in which it was supposed to be demerged is not yet incorporated. Obviously, the scheme needs to be read properly and taken on MR as to what they are proposing to do. Up till now, what we had dealt with, whenever I have given examples of merger of A into B Limited or a demerger of an undertaking of A Limited into B Limited, I have generally mentioned that B Limited issues equity shares to the shareholders of A Limited. But practically, you may also see sometimes the transferee company issuing redeemable preference shares, optionally convertible redeemable preference shares to the shareholders of the transferor company. So what does one do in such cases? Now here again the relative value concept will fail, because if you are valuing a redeemable preference shares of any entity, you will not be able to use a comparable company's multiple method. In most cases, you will end up using a discounted cash flow method, which means that you will take into account the future dividends which are expected to be received on such preference shares, and the redemption amount, and those will be discounted to arrive at the present value of the RPS. Whereas for the company, which is the transferor company, which where the business is getting transferred, you will end up using a CCM method and a DCF method. So one needs to be sure about what is written in the scheme in the consideration clause and confirm their understanding with respect to what is being issued and in case of merger or demerger. Now we are going to deal with certain case studies, which will be more on mergers and demergers involving various steps. So up till now, we were talking only about a single step, either there is a merger or a demerger. However, practically, you will see cases where there is a capital reduction and a merger or a demerger. You may say preferential allotment and a merger and a demerger. You may see that there is first demerger and then merger. You may see a case where there is demerger first and then there is a merger. So let's delve into those cases. Now, for all these cases, it is very important for a valuer that they should go through the draft scheme of amalgamation or arrangement and confirm their understanding as to what management has explained and what is written in the scheme is exactly the same. So let's look at the first case. In the first case, if you see, there is A Limited and B Limited. In the first step, AB Limited proposes to have a preferential allotment of shares to the promoters of B Limited. That is step one. And then post this preferential allotment, in step number two, there is a proposal to merge A Limited into B Limited. Now they are both forming part of the scheme. It's not that this has happened. Step one has already happened and we are just looking at step two. They are both forming part of the scheme. So how does as a valuer you will deal with it? So in the first step, because there is a preferential allotment of B Limited and B Limited is unlisted in this case, the registered valuer will carry out the fair valuation of B Limited. Then coming to the second step, where there is a merger of A Limited into B Limited, the registered valuer will have to recommend a share exchange ratio, which would involve valuing the shares of A Limited and B Limited. So the registered valuer will work out the relative value per share of A Limited, no issues. But while working out the relative value per share of B Limited, he will have to take into the impact of the preferential allotment by taking into account the fund infusion which is expected, and also divide the value by a higher equity base of B Limited post considering the preferential allotment. This was done in the case of Z and Sony Pictures, where the scheme is yet not gone through. In fact, in this scheme, there's a bonus and a split also as part of the scheme. So it is a very interesting scheme, and one can refer to the scheme as well as the report which has been issued in this regard. So if you look at post-merger, B Limited will have the shareholders, its own shareholders, as well as the shareholders of A Limited. Now here, I have spoken about preferential allotment. Say if there is a capital reduction in step one, whereby B Limited reduces its share capital. Then in step two, while I am arriving at the value per share of B Limited, I'll have to take into account the capital reduction impact, which could be either if there is any cash paid to the shareholders, then one will have to reduce that from the overall value of B Limited. And while dividing it with the number of shares of B Limited, the reduced number of shares will have to be taken into consideration to arrive at the relative value per share of B Limited. Now let's look at a case where there are two steps involved. First, there is a merger and then there is a demerger. So in the first step, if you will see, there is a proposal to merge P into Q Limited, and Q Limited will allot shares to the shareholders of P Limited. In step two, post-merger, first step, there is a proposal to demerge one of the division of the merged Q Limited into its wholly owned subsidiary R Limited. Here, R Limited's existing share capital will be cancelled. R Limited does not have any business, and therefore R Limited will issue shares to the shareholders of the merged Q Limited, which will mean that R Limited will have to allot shares to to both the shareholders. So the way we look at it, because in the first step, a merger has happened. Okay. So you will say that in the second step, a Q Limited is a merged entity having two sets of shareholders already. And therefore, while considering the share entitlement ratio for the demerger, one will have to take into cognizance the post-merger share capital of Q Limited and then recommend a ratio. In this case, if you see the resultant structure, merged Q Limited with the residual business will have two sets of shareholders, shareholders of P Limited and shareholders of Q Limited. And R Limited post demerger will again have two sets of shareholders. This is arising because of the fact, because the first step there was a merger. One can refer to the Aditya Birla Nuvo Limited and Grasim Industries scheme of 2016, which dealt with this particular case. Now let's look at a reverse case where there's a demerger first and then there is a merger. So you have P Limited, where first you are considering a proposal for demerger of X division of P Limited into R Limited, similar plain vanilla demerger mirror image shareholding, which we are talking about. And therefore, R Limited will issue shares to the shareholders of P Limited. Post this step, as part of the same scheme, there's a proposal to merge the residual P Limited after one division has gone out. Whatever is there in the residual P Limited is proposed to be merged into Q Limited. Now here, while arriving at the relative value per share of P Limited, how will one determine what is the value? So while carrying out the relative value per share of residual P Limited, one needs to exclude the division which has been demerged. So if X division has moved out, one cannot consider the value of that division while arriving at the relative value per share of P Limited for the purpose of merger into Q Limited. Secondly, if say P Limited were listed in this case, market price will still not be considered because what is being demerged now is not that original P Limited in its entirety. Only the part of P Limited is getting merged, and therefore the market price method will also not be applicable. Here, if you look at the resultant structure, R Limited in this case has only shareholders of P Limited, unlike the previous case where it has two sets of shareholders. The reason being here, the demerger is happening first and not as a second step. Merged Q Limited will have two sets of shareholders similar to the first case. One can refer to the scheme of Motherson Sumi and Samvardhana Motherson in this case, which involved these steps. Now let's look at a slightly different, very peculiar case not seen very frequently. Here you have E Limited, and then there is F Limited. F Limited has a wholly owned subsidiary, G Limited. There is a proposal that E Limited will demerge one of its division to G Limited, which is the subsidiary of F Limited. And in consideration for the demerger, instead of G Limited allotting the shares, here the holding company of G Limited, which is F Limited, is issuing equity shares to the shareholders of E Limited. Now here, while arriving at the relative value, while arriving at the share entitlement ratio, one will carry out the relative value per share of division of X of E Limited. And the second relative value per share will be of F Limited, who is allotting the shares and not of G Limited. So it's a slightly different case where one needs to keep in mind that the relative value per share of F Limited needs to be determined and not G Limited, based on which the share exchange ratio will recommend. Then there was a subsequent step where the residual E Limited was merging into F Limited. Now here again, the previous example which we discussed, it's similar. While arriving at the relative value per share of E Limited, one will have to exclude the division which is got demerged and then arrive at the relative value. This case is of Tata Consumer Products Limited and Tata Coffee Limited. There was a similar case of Fortune Financial Services also, which had taken a couple of years back. Not many cases in this area. Again, this is an interesting scheme, and one can refer to the valuation report in this example. This brings me to the end of the presentation, and we can take up questions now.
So, ma'am, there are a lot of questions. First question is, in case of two valuers, how will final ratio be arrived at? What if both valuers give different ratio?
What is the final ratio? So basically, practically, as I see it, I have not seen any cases where there is not a consensus on the ratio. Ultimately, the board, if if there is a case where there are two different ratios, ultimately the board will have to take a call as to what ratio they want to recommend, but not sure whether the minority shareholders will approve such a case, or even the stock exchanges or the SEBI will approve such a case. Maybe in that case, they may have to appoint a third valuer to get a ratio. I'm not very sure as to how one will deal with this such cases. Practically not seen in the last maybe 10 years, 15 years or so.
Thank you so much. The next question is, will the exchange ratio of equity shares be used for CCDs as well? What about OCDs?
So primarily, if you in mergers and demergers, generally OCDs have not been seen, because if you look at section 21B or 219AA, one of the condition is that all the shareholders of the transferor company needs to become the shareholders of the transferee company. So practically, you may not find instances where OCDs are being issued or CCDs are being issued. Means even if they are issuing it, maybe CCDs, if you're looking at it, the way the terms and conditions are there, you may still adopt similar methodologies for depending on the conversion terms, you may still use the similar methodologies which you would have used for arriving at the value per equity share. But if it's an OCD, ideally it involves a combination of debt, valuation of debt plus the option value.
Next question is valuation required for a company without any assets and liabilities and company that has been in existence for more than 6 years?
Can you repeat that question again?
Is valuation required for a company without any assets and liabilities and the company has been in existence for past 6 years?
They will definitely have some assets and liabilities. So I'm not sure how can there be a company with no assets and liabilities if it has been incorporated since last 6 years.
Maybe they're talking about a shell company or
Yeah,
something
but
like
then it will definitely have some cash sitting or
something.
something will be there. Yeah, so I don't think so there will be a case where you don't have anything in the company.
So the next question is whether there are any specific parameters for merger proposal of listed company with unlisted company controlled by promoters or relative of promoters.
Whether there are any, sorry, can you repeat the initial part? Whether there are any?
Whether there are any specific parameters for merger proposal of listed company with unlisted company controlled by promoters or relatives of promoters.
So, in terms of valuation, the valuation norms do not change as far as these companies are concerned. However, I think so there are certain conditions in terms of the shareholders' approval which one needs to comply with, which does not have a relevance on valuation. It is more from the merger process perspective. But in terms of valuation, whatever valuation one would have done in a normal case, one will have to follow those principles. So it does not change just because the entity is being owned by a promoter or the entity is not being owned by a promoter. I don't think so there can be any distinction when it comes to valuation, because when you talk about valuation, it's just about talking about a fair valuation. We are not talking about being a biased to anyone.
Thank you, ma'am. Moving forward, how to determine which valuation method to be used in which company?
Again, this question is more from, I can say, normal valuation, which you will have done for any business. So say if you're doing an investment holding company, you will end up using a net assets value method where the underlying investments will be done based on fair value. If you are doing a valuation of a service company, then primarily one would have used a DCF method or a CCM method or both. If you are doing a manufacturing company, again, one may use a DCF method and a CCM method. But if you are doing, say, a company which has just started operations, it has just started operation in means of 2 years and it is still in the expansion phase. In such cases, one may ignore the CCM method and may use a DCF method only because it has not yet captured the entire potential of the company. So again, selection of methods will depend upon the nature of business, the stage at which the company is, and the type of company which we are talking about.
Thank you. The next question is, how valuation is done for loss-making companies like Zomato, Flipkart, which are in losses for years?
So here, I think so the way the valuations are being done for all these unicorns, startups, the way these valuations are being driven are slightly different from a normal manufacturing company or a normal IT company. The parameters which are used for these valuations are slightly different versus what you would have done in a normal valuation. And if we have to delve into those valuations, it requires a separate session per se. And I'm sure we have covered these sessions in the past for startups and everything.
Ma'am, probably. And just for the knowledge of all the participants, I would like to tell you that if you want to see any past sessions, then you can visit the YouTube channel of ICAI and you can uh, go and see what all sessions we have covered. Moving forward with the questions. Even an unlimited company needs an audited financials. Can the financials be prepared on any date to keep the period within 3 months, or are there any conditions?
No, there are no conditions. It just says that if, so for example, if I'm issuing a valuation report on, say, 31st of December 2023, my audited financials should not be older than 30th of September. That means I can have audited financials as of 31st October also and still have a valuation date of 31st December. There is no criteria. They are just talking about that the duration should not be more than 3 months. That's what they are looking at. Basically, they are trying to say that we don't want valuations to be done on some old accounts. Previously, all those things were permitted, but now they are being extra careful in terms of protecting the interest of the minority shareholders. That's it.
Thank you, ma'am. Moving forward, what is the difference between share exchange ratio and share entitlement ratio?
Okay, so I'll just reiterate again. If you remember at the start of the presentation, I explained the concept of merger and I explained the concept of demerger. So generally, share exchange ratio is used more in the context of merger, and share entitlement ratio is used more in the context of demerger. Sometimes people are using these terminologies interchangeably, so it does not matter so much. But to be more specific, share entitlement ratio is generally that term is used when it comes to demerger.
Thank you, ma'am. Moving forward, whether valuation report to be based on the audited financial statements of unlisted company for transfer of shares to overseas entity by an Indian company.
So this, whatever I explained about this audited financials is only with respect to mergers and demergers involving unlisted and listed companies. In normal case of transfer of shares, this requirement is not there because SEBI regulations do not apply over there. It is only for the purpose of merger and demerger.
Moving forward, what would happen in case of fast track merger? Valuation report, will it be required?
Yeah, for fast track mergers also the valuation report is required. And it is mentioned in that specific section which deals with fast track merger.
In case of startup company, can shares be allocated at a price less than valuation, say 90% of the value?
Sorry, I repeat that question again.
In case of a startup company, can shares be allocated at a price less than valuation, say 90% of the value?
No, I have not understood this question because I don't know why the shares will be allotted at less than the fair value. Not understood
Um,
this question.
so maybe the participant can reshare the question,
Yeah,
rephrase
yeah.
it. Moving forward, in slide 24, could you please repeat the concept of appointed date and valuation date?
Yeah, sure. So appointed date. So any merger or any scheme of demerger, generally you will have this definition of appointed date. Now, what is this relevance of appointed date? It means that with effect from this appointed date, all assets and liabilities of the transferor company or the demerged undertaking will be transferred to the transferee company. So even if you look at the accounts or something, when they are post merger, once the merger has been approved, they will say that the scheme is effective from a prospective date, but it is effective from the appointed date, which will mean that you will account all the assets and liabilities as if as on first, say for example, if the appointed date was 1st April, 1st Jan 2024, the business, the employees, the assets, liabilities, any contracts, all are assumed to be transferred to the transferee company from 1st Jan 24. This has no relevance when it comes to valuation because valuation has to be done as of the current date. So it's different. So one needs to read the schemes to have more clarity on what is the appointed date. One needs to read the accounting standards as to how, when there's a merger or demerger, how the accounts are formed and how the appointed date is important in such cases.
Thank you, ma'am. Moving forward, this is with respect to slide 32. Since market prices determine daily, logically daily, VWAP is a more accurate representation of the price as compared to the combined VWAP as shown on the left. What are your views on this?
So, I, in my view, the first one, which is the volume weighted average price, is a more better way of calculating the market price, because here you remove all the volatility which will happen on a particular day. And I will consider the total volume and total turnover which has been traded. In fact, as I said, even the takeover regulations of SEBI and the SEBI ICDR regulations, they are also now using the formula of volume weighted average price. In fact, if I remember ICDR regulations, the earlier one, which were there prior to the new pricing formula coming in, there was this daily volume weighted average price, which in fact now they have shifted to the volume weighted average price.
Thank you, ma'am. Moving forward, in case two NBFCs merge on 1st January 23, RBI returns would be filed consolidated or independently.
I am not sure on this, on the RBI filing returns and the process for that. Sorry.
Moving forward, can you please explain the difference in face value of shares? I think that this is related to some slide. The participant has not mentioned the slide.
No. So, I had put that question specifically just to bring out the clarity that while you are recommending a share exchange ratio for the merger of two companies or for a demerger of an undertaking into another entity, the face value of the shares of the transferor and the transferee company has no relevance while recommending a share exchange ratio. What is relevant is the share and relative value per share, which the valuer has worked out for determining the share exchange ratio. So, irrespective of whether your face value is 10, 100, the share exchange ratio will not have impact. Relative value per share is what is relevant for determining the share exchange ratio.
Thank you, ma'am. Moving forward, this question is with respect to slide 25. How do we value OCDs?
For valuation of OCDs, as I mentioned in the one of the earlier questions, it will entail the valuation of a debt instrument plus the option which is attached to that instrument. And obviously, it will have DCF method, and for option value, you may end up using one of the option valuation models. And obviously, one needs to consider the terms and conditions. So it really will be driven by the terms and conditions of the OCD, and it will change from facts depending upon the facts.
Moving forward, will delay between appointed date and merger approved date in any way alter the valuation price?
So, delay in, sorry, can you repeat that question? Delay in?
Will delay between appointed date and merger approved date in any way alter the valuation price?
So, what happens in a merger process is, as I said, once the scheme has been approved and the share exchange ratio has been approved, there is a shareholders meeting which has to be conducted for approving the ratio or accepting the ratio. Now, once the shareholders have accepted it, unless there is any litigation or anything, for some reason, if the merger gets delayed, and the ratio may not be revised because the report was issued as on a particular date. And if the shareholders have approved, if the creditors have approved the scheme, and for some technicality, maybe some government approval or something is pending, will not impact the valuation later on. Because what we are saying is this valuation report was issued earlier at a particular date, and the appointed date is also fixed. So, according to me, unless someone says that we are withdrawing the scheme and now a fresh scheme will have to be taken up, then one will go ahead with a new valuation report and everything.
Ma'am, moving forward, can we use consolidated projections to value a company which has subsidiary which is also into similar business?
Yeah, it can be used. So it depends upon how the management provides you the information. Sometimes management prepares projections, say entity wise, and they give it to you. Sometimes they will give you consolidated projections. Obviously, the consolidated projections will have assumptions as to how they have been consolidated, and one needs to look at those assumptions and then take consolidated projections into account. So to say yes, primarily, basically, one can consider consolidated projections.
Moving forward, ma'am, in case of a private company, when there is a transfer of shares between family members or between friends, where the valuation of share is to be done every time?
So if it is between family members or it is between closed group, as such, there is no requirement under Companies Act to carry out a valuation. But I think so under Income Tax Act, there is a valuation required under Section 56 to 10, which is primarily based on the Rule 11 UA formula, based on which the valuation may have to be carried out just to, check that there is no tax implications which are arising as a result of the transfer between the family members. Otherwise, Companies Act does not insist that if there is a transfer between family members, there is a valuation required.
Thank you, ma'am. Moving forward, can a valuation report be obtained today for a valuation date in the past?
Yeah. So one can issue a valuation report today with a valuation date which is pertaining to the past years. So there are many cases where people want to arrive at the valuation of shares as on 1st April 2001 because of the requirement under Income Tax Act. There are certain cases where there are certain family settlements or litigations going on, and the valuation is required to be done on a some past date based on the understanding of the family or based on what the court decides. And in such cases, one can always issue a report, but the report has to be dated today.
Okay, ma'am. What happens to intercompany receivables and payable in case of merger demerger?
As far as valuation is concerned, there is no uh, separate adjustment required because you will do it in the normal course, the way you would have done any valuation. Post merger, ideally, this intercompany receivables and payables get cancelled as far as the preparation of books of accounts are concerned, but it does not have an impact on the valuation.
An unlisted company is doing business of energy transmission, electricity, how to arrive its equity share on the price of its equity share.
Can you repeat that again?
An unlisted company is doing the business of energy transmission, how to arrive at the price of its equity share.
It's a normal business valuation, right? Which you would have done either a DCF method or a CCM method and arrived at the value per share.
Moving forward, when there is a preferential issue before merger, how does the valuation report of merchant banker is dealt vis-a-vis the merger related valuations?
Can you repeat that question again?
When there is a preferential issue before merger, how does the valuation report of merchant banker is dealt vis-a-vis the merger related valuation?
So if there's a preferential allotment, this is in case of listed company, has he mentioned as the
No, ma'am. There's no such mention of
I
listed
am sure
organization.
it will be for a listed company. So preferential allotment in case of a listed company is as per based on the ICDR pricing formula, which we discussed during the presentation, which is that the price of the listed company shall not be lower than higher of the 90 trading days volume weighted average price preceding the relevant date or 10 trading days volume weighted average price preceding the relevant date. Not sure why a merchant banker report will be required in such cases. And once the preferential allotment is determined based on the ICDR pricing, if there is any merger or demerger happening later on, I am not very sure how and what needs to be dealt. But definitely, while dealing with the merger valuation, one will have to consider that preferential allotment funds which are coming in and take the higher equity share base.
Okay, ma'am, moving forward, in a startup company, if the investor wants to invest at 90%, this is the question that
Yeah.
I asked initially. In a startup company, if the investor wants to invest at 90% of the valuation report, can the company go ahead or do they need to get a new valuation report at 90% again?
At 90% of the previous valuation.
So it doesn't specify that there was a valuation which was done before, but the question is that in a startup company, if the investor wants to invest at 90% of the valuation report, so can the company go ahead or do they need to get a new valuation report at 90% again?
So I am not very clear on this question, but ideally, if the valuation of the company is 100 rupees, why would the company accept any value which is less than 100 rupees? I have seen reverse cases where the valuation may be 100 and you may take funding at 110. Reverse case, I don't know whether it will be right to do it because from corporate governance perspective also it could be an issue because where the fair value is 100, why would you give any investor at less than 100 rupees?
Okay, ma'am. Moving forward, within how many days valuation report shall be submitted from the date of commencement of merger process?
So the valuation, the way the merger process works, basically first the companies need to get the draft scheme of arrangement ready, and they need to obtain the valuation report for the merger first. And post that, there is a board meeting which is supposed to be held for approving the scheme as well as the share exchange ratio. Generally, what happens is, in case of listed companies, I have seen practically in most of the cases, the valuation report is issued on the day of the board meeting, which is held to approve the scheme. In case of unlisted companies, maybe once the report is issued, I have not seen that people will just take the report and not hold the board meeting for approving the scheme. Even there, I think so within a day or two, unlisted entities also approve the scheme. I have not seen that where an old valuation report is being used to approve a scheme after 2 3 months. I have not come across such cases. Maybe it will be a little challenging to use a old valuation report and then hold a scheme to approve a scheme, hold a board meeting to approve the scheme. In fact, for listed companies, they have a timeline of 7 days, which has been laid down under the SEBI regulations. Having said so, in listed companies as well, I have not seen people taking the report and doing the meeting after a gap of 4 5 days. I have seen that immediately on the same day the board meeting is held, most of the cases.
Now, moving forward, in case of a NBFC private limited company, where valuation done by valuer is less than NAV, which one should be considered?
Can you repeat it again? Sorry.
In case of a NBFC private limited company, where valuation is done by a valuer, where the valuation is done by the valuer is less than NAV. So, which one should be considered? Maybe the actual valuation or the price which is less than NAV? Well, the question is not complete in that respect.
I think so. In case of an NBFC, generally one uses a book value multiple method. Now, that will mean that if the multiple is less than one, there are chances that the value which is arrived at is lower than the net assets value. In such cases, I will still not sure whether why the multiple should be less than one. Is there any reason for giving a multiple which is less than one? One needs to first check that. That is the only way that the value can be lower than the book value. But I have not come across cases where the multiple will be less than one.
Thank you so much. Moving forward, this is the last question. Is there any outer time limit defined under Companies Act for completion of the scheme of merger?
There is no time limit mentioned in the Companies Act for completion of the entire merger process. In fact, some schemes may take even 2 years to get it approved. Some schemes may get approved in 9 months, also 6 months, also. So it all depends upon what are the complications involved in any scheme and how long are the NCLT and SEBI taking to approve any scheme.
So thank you so much, ma'am. With this, we come to an end of this session. It was a great, insightful session, and thank you so much for sharing great insights with us. It was a learning experience. And dear participants, as we conclude this session, we extend a sincere thanks to our distinguished speaker, CA Bhakti Shah Ma'am Ji, for her valuable insights. We also express gratitude to our chairman, CA Hansraj Chuk sir, Vice Chairperson CA Preeti Paras Savla ma'am, and the entire support team of ICAI for initiating and supporting this platform for the field of valuation and guiding us. So, and we also acknowledge and appreciate our audience for dedicating your valuable time and for your active participation. Thank you so much. We are eager to meet you again in the upcoming sessions. Thank you and have a wonderful day ahead. Thank you.
Thank you.